So story time. Back in the day, if you were a rich old fellow with some children and grandchildren that you were passing down your multi-million dollar estate to, it was common practice for a little while there for those humble beneficiaries, once you had bitten the dust, to say, well, granddad or great-grandma or whoever gave us this money as a gift. And the reason that this was common practice for at least a little while there was because the United States had recently passed its first estate tax. In other words, if it had come as an inheritance, if that estate had been in traditional form as an estate, you would have had to pay estate tax on it. But as a gift, you wouldn't have had to. So the IRS got wise very quickly and eliminated that provision by instituting something known as the gift tax. And in today's Financial Prof video, that's what we're going to talk about. Hi, I'm John Norberg, and welcome to the Financial Prof series. Alright, so the gift tax. Let's talk a little bit about this and dive in, shall we? So first things first, and I know I'm going to lose a lot of my viewers right here, so if you stick around, kudos to you, right? The gift tax only applies if you have given away or will have given away in excess of $13.99 million over the course of your lifetime. And by the way, if you're married, your spouse gets another $13.99 million. This is as of 2025, and that amount is indexed to inflation, so is likely to go up in future years. However, unless Congress acts in 2025, that amount is actually slated to be cut in half in future years after the expiration of the Tax Cuts and Jobs Act at the end of this year. So, especially if you've been curious about whether this applies to you or not, it might be worth listening in. What is the gift tax? Well, it applies on the transfer of property by an individual to another individual while receiving nothing or less than the fair market value of that thing in return, whether or not the giver intends it to be a gift per se. Now, the tax applies to the gifter, not the giftee, meaning in this case that it truly is more blessed to receive than to give, because if you received, you don't have to pay the gift tax. The giver does, right? Maybe not always fair, but that's the way it works. So if you do receive a gift, you probably don't have to worry about the gift tax except in a few rare certain special circumstances that we're not going to get into in this video. But if you are giving a gift, then you might have to worry about it. If that gift is under $19,000 per individual, then you're good to go. But if you're giving a gift in excess of $19,000, then what happens is you have to record that amount on Form 709 with the IRS. And what then happens is that amount gets applied against your lifetime exclusion. So remember that $13.99 million amount I mentioned a couple of seconds ago? That's the lifetime exclusion amount. In other words, everybody, every John and Jane Doe in the United States, can gift up to $13.99 million over the course of a lifetime, and gift tax will never ever apply. But the second you give a dollar above that amount, now gift tax applies. And that can range anywhere from 18 to 40% of that gift. And it depends on a number of circumstances, including the form of the gift, the amount it is, etc., etc. We're not going to get into those specific details, but know that up to 40% of that amount can then become taxable. And the reason is because this is a way for the IRS to get that tax revenue that they otherwise would have gotten at the estate level when you pass away. So it's to dissuade people from gifting things out of their estate for the express purpose of removing it from the estate tax, which would eventually come. Right? Okay, so if you give $19,000 or less, you're good to go per year per individual. Quick example, let's say you have 5 kids. You can, in that case, give $95,000. And guess what? If you have a spouse, that amount gets doubled, right? Through split gifting, as it's called. So you and your spouse, in that case, could give $190,000 total to each of these 5 kids. $19,000 for the husband, $19,000 for the wife, per child, times 5 equals $190,000. With me so far? Great. The minute you give above that amount, again, you do have to record it on the Form 709. And the thing is, if it's something that is gifted as like art or a wine collection or a really fancy sports car, right? then you're supposed to use the fair market value. And this is where things do get maybe just a little bit squishy as far as valuations and whatnot. It's always good to bring in a valuations expert, especially once we do start getting into those 6 or 7 digit or 8 digit price tags on gifts. Real estate is another common example, right? But it's important that at least you are showing that you are giving your best effort to try to value these things fairly. The key, again, as with anything IRS related, is that if you feel quite honestly that you have the documentation and the intent to be able to sit before that IRS audit agent with a straight face and say, yes, this was our strategy, this is what we were doing to comply with the law in terms of this gift taxing situation, then you're probably going to be good to go. Again, we always want to comply with the law, pay the IRS what they are due, but without leaving them a tip, right? Now, there are a few exceptions to the gift tax application, right? So gifts, obviously, of $19,000 or less, that's exception number 1. Don't have to worry about gift tax at all. Tuition or medical expenses that you pay for someone directly to that medical or educational institution. Don't have to worry about it. Could be any amount. Gift tax doesn't apply. Gifts to your spouse, so if you as a husband give a whole bunch of money to your wife or vice versa, doesn't apply, right? And then finally, gifts to a political organization for its use. So this is why you oftentimes see these big checks being written to political organizations. They don't count. I'm sure the politicians had a hand in writing that particular section of the Internal Revenue Code. Anyway, one more exception, kind of hinted at this earlier, does exist for 529 plans. So another common strategy, especially now that we have the new flexibility to use Roth IRA funds that haven't been used for education purposes, to roll them out into a Roth IRA. This is becoming an increasingly common strategy where you superfund a 529 plan by putting 5 years of contributions in at once, get that gift out of your taxable estate, and then whether or not it gets used, there are other uses for it down the road. And again, gift tax doesn't apply. One more quick note. If you do give a gift that is a taxable gift to a person who is 37 and a half years or more younger than you, a generation skipping transfer tax applies of 40% of that amount, because what you're in essence doing is taking that gift not only out of your estate, but potentially out of the next generation's estate. So that's why the IRS, again, are trying to close that loophole by doing so. Anyway, if this sounds like something that you want to learn more about, or you're worried about how the gift tax might apply to your current situation, your past situation, or your future situation, we would love to hear more from you. Give us a call or drop us a line here at Norbert Wealth Management. We're happy to talk more. In the meantime, I'll see you.